If you're someone who has already explored mutual funds, SIPs, or even dabbling in the stock market, chances are you're looking for your next big investment opportunity. That's where specialized investment funds or SIFs come into play. Introduced by SEBI in April 2025, SIFs are India's newest mutual fund category aimed at bridging the gap between traditional mutual funds and portfolio management services (PMS). With a minimum investment of 10 lakh rupees, they are tailored specifically for high net worth individuals looking to tap into advanced investment strategies, think long short equity, derivatives, sector rotation, and even private equity style structures. Now let's walk you through exactly how to invest in these SIFs. Step 1. Begin with self-assessment. Before jumping in, evaluate your financial goals, investment horizon, and most importantly, your risk tolerance. Unlike SIPs where you can start with 100 rupees, SIFs are lump sum based and involve complex strategies. SEBI allows SIFs to invest up to 25% in derivatives and up to 15% in a single security. That's significantly higher exposure than regular funds. That means potential for higher returns but also more volatility. If you're aiming for alpha and have the capital to spare, SIFs can be a great alternative, especially in unpredictable markets like June 2025, where the Nifty Midcap 100 has dropped 16% from its recent peak. This is also the point where you may want to consult a SEBI registered financial advisor to see if SIFs align with your overall portfolio. Next comes KYC. Know your customer, which is a mandatory compliance requirement set by SEBI. If you're already investing in mutual funds, you may have completed this step already. But if not, gather your PAN card, Aadhaar card, address proof and bank details. You can submit these documents digitally through platforms like Zerodha, HDFC Securities, ICICI Direct, or directly via the asset management company's website. Most AMCs offer fully digital onboarding, including e-sign and Aadhaar verification, making the process seamless. Once KYC is complete, your focus shifts to selecting the right AMC, that's asset management company, because not every AMC can launch a SIF. SEBI's eligibility criteria state that only AMCs with a 3-year average AUM of 10,000 crore rupees or with a CIO having 10 plus years experience managing 5,000 crore rupees are allowed to offer these funds. As of June 2025, AMCs like HDFC Mutual Fund and Kotak Mahindra are actively preparing to launch SIFs. So start by researching which of these SEBI qualified AMCs are offering SIFs, what their investment philosophy is, and how experienced their fund managers are. Now comes the fun part, choosing the right SIF scheme. These funds come in 3 structures: open-ended, close-ended, and interval. Open-ended funds allow daily entry and exit, giving you liquidity. Close-ended funds are locked in for a fixed period, making them suitable for private equity or thematic strategies. Interval funds, on the other hand, allow redemptions only at certain intervals. Depending on your liquidity needs, pick a structure that suits you. Also pay close attention to the fund strategy. Some funds may focus on equity long-short models, while others might specialize in debt arbitrage or thematic sector plays. Be sure to read the scheme information document for a complete understanding of the risk profile, investment allocation, and expected performance metrics. Once you've identified the scheme, the next step is to register and open your investment account. You can do this directly through the AMC's official website or via investment platforms like CAMS, KFintech, or third-party brokers like Paytm Money and Grow. Make sure the broker or platform is SEBI registered. During this step, you'll be asked to verify your KYC, link your bank account, and complete any final documentation. Some platforms even allow UPI-based payments, though high-value investments like these often require NEFT, RTGS, or net banking for smoother processing. After your account is set up, go ahead and initiate your investment. Enter the amount. You must invest at least 10 lakh rupees and complete the payment. Once the funds are received, the AMC will allot units based on the scheme's current net asset value, NAV. For instance, if the NAV is 100 rupees, a 10 lakh rupee investment will fetch you 10,000 units. Remember, these NAVs fluctuate depending on the fund's market performance, strategy execution, and exposure to derivatives or other assets. You'll receive a transaction confirmation and a soft copy of your account statement once the allocation is done. After investing, it's crucial to monitor your portfolio's performance regularly. AMCs are required by SEBI to publish monthly NAV updates, disclose their portfolio holdings, and offer risk metrics such as standard deviation and Sharpe ratios. You can track these on the AMC's site or use platforms like Value Research, Morningstar, or your broker's dashboard. The nature of SIF strategies, especially those involving derivatives or short positions, means your NAV could swing more sharply than a regular mutual fund. So stay alert. Eventually, you will want to redeem your investment or switch strategies. SIFs come with varied redemption options based on fund type. Open-ended SIFs allow daily redemption, usually with a T+2 settlement. Interval funds may offer redemptions quarterly or half-yearly, while close-ended funds can only be redeemed at maturity. There may be an exit load if you withdraw before a certain holding period, so always check the terms in advance. Taxation is another key factor. SIFs categorized as equity-oriented enjoy a lower long-term capital gains tax of 12.5% compared to 15% in regular equity funds. Short-term gains and non-equity funds may fall under different slabs, so consult your tax advisor or use a capital gains calculator to understand your post-tax returns. Finally, once you've made an investment, don't stop there. SIFs allow up to 15% exposure to a single stock, which is higher than the 10% cap in mutual funds. So, portfolio concentration is a real risk. It's wise to diversify, not just across different SIF categories like equity and hybrid, but also across asset classes. Consider balancing your SIF exposure with safer instruments like large cap mutual funds, fixed income funds, or even gold ETFs. This layered strategy helps cushion volatility and gives your portfolio more stability. To better visualize where SIFs sit compared to other options, let's look at a quick comparison. While mutual funds allow investments as low as 100 rupees, SIFs start at 10 lakh rupees and PMS requires a minimum of 50 lakh rupees. In terms of risk, mutual funds typically have a risk level of 2 out of 5, SIFs hover around 4 and PMS tops the chart at 5. This places SIFs right in the middle, offering aggressive strategies with some guardrails, but certainly not for the faint-hearted. SIFs are not just another fund category, they're a gateway to the kind of investment tools and strategies once reserved only for ultra HNIs. With SEBI's backing, these funds bring transparency, structure, and credibility to complex investing. But remember, with higher returns come higher risks. Do your due diligence, read the fine print, and consult experts before jumping in. So what do you think? Are you ready to explore SIFs and take your investing game to the next level, or would you rather stick to your SIFs and play it safe? Drop a comment below and let's discuss. If you want a deeper dive into how specific SIF strategies like long short equity or sector rotation work, let me know and I'll cover that in an upcoming video.